David, taking a closer look at real estate, which we should point out, real estate stocks, at least today, are on fire on the back of that Fed meeting yesterday that saw rates come down.
Who can blame them? But they had a fairly rough 2023. So the question is what happens next year? And to answer that question, we welcome now Lauren Hochfelder. She's Morgan Stanley Real Estate Investing co-CEO. Lauren, thank you so much for joining us. Welcome. So we did have a rough year in real estate in 2023, as Romaine points out. Coming back now with Jay Powell's encouraging remarks, what are you looking for in 2024?
Sure. Well, we invest in real estate on a global basis, and we've been at this for 30 years. We find this opportunity, honestly, amongst the best we've ever seen. So we're seeing deep distress in the toughest real estate assets, but really what's more interesting is dislocation across the board. So to see how different real estate assets are going to behave, you really have to start with what real estate is, which is a function of how people use space, how we want to buy goods, where we want to live, where we may want to go to the office if we ever go back. So we really start there, and we think there's going to be just wide bifurcation based on these shifts in how people are behaving.
So when you say dislocation, I think about issues in the market where there's some things that you could buy cheap. If not cheap, at least things that will grow beyond where they are now. Where do you see those opportunities?
Sure. Well, we really want to be behind those long-term mega trends that are shifting behavior. So we start with industrial. So the last 10 years in industrial has been all about e-commerce growth. That's a trend we identified early, and we started buying and building those warehouses that get goods to our front doors. And that's been an extraordinary opportunity for our investors, as assets over the period we've been investing have doubled and tripled in value on an unlevered basis. We think there's still a little room to run there, but beyond that, we're seeing two more trends really driving demand. So the first is a supply chain overhaul, which we're seeing on a global basis. And really we're seeing companies diversify their supply chain. They learned the hard way during COVID. You can't put all your eggs in one basket. And they're feeling pressures around deglobalization, geopolitics, et cetera. So that's creating more aggregate demand, and it's changing where that demand is with winners and losers.
I am curious about other parts of the commercial space. We've seen a lot of interest in healthcare type facilities. That has done pretty well here. Have you ventured down that road, and if so, to what degree?
Yeah, absolutely. Well, if you think about the U.S. in particular, what is it? It's millennials and boomers, and the boomers are aging, and that's creating different needs in their real estate. So we're seeing increased demand for senior housing. That's a big driver. We're seeing increased demand for medical office. And we think the amount of spending going into healthcare is just increasing exponentially, and in turn, the need for healthcare-oriented real estate is growing. So yes, we're very active in that space, and it's been a great opportunity.
I do want to get your thoughts here about interest rates. We know, at least in the market, interest rates are already coming down, and most people expect Fed interest rates to come down at some point in the near future. Earlier this year, all the talk was about this sort of refinancing cliff, particularly when it comes to commercial and office properties, to be very specific here. I'm wondering if you see maybe a little bit more of a light at the end of the tunnel in this whole saga, that if interest rates indeed are truly coming down, does that take some pressure off some of those properties and some of those, more importantly, some of those owners who really were facing that refinancing cliff?
Yeah. Look, it depends on how much they come down and how quickly. So when you're looking at $1.5 trillion of real estate maturities, real estate debt maturities over the next few years, and a whole wall of corporate maturities as well that may trigger activity in real estate land, I think the opportunity set is still really there. So there's simply a pullback from lenders. You look at the traditional banks, whether it's the large banks or the regionals, and the reality is they're trying to reduce their commercial real estate exposure, whether for regulatory reasons or other, and that creates a deficit, that creates a capital need, which should catalyze selling, recapitalization opportunities, opportunities to provide structured finance, et cetera.
You talk about the supply chain, the changes there. Does that mean in the United States? Does that mean in Mexico? We have some people saying there's opportunities in industrial in Mexico, nearshoring, or is it all of the above?
So it's all of the above. So the U.S. is a huge beneficiary of obviously the nearshoring and reshoring trends. So we're bringing manufacturing back here to the U.S. That's great for U.S. industrial. Manufacturing in Mexico is also great for U.S. industrial. So we've been investing along the southern border for quite some time, and there's real demand there coming out of that manufacturing in Mexico. We're also seeing demand in places like India. So as manufacturing diversifies away from China and into India, that's been great. We own a lot of industrial in India. And frankly, that shift to India even creates or shifts the demand in the US, because when you're importing goods from China, it's coming into the West Coast, and when you're importing goods from India, it's coming into the East Coast ports. So lots of change.
We were talking about commercial. What about residential?
Sure. Look, residential, you have to bifurcate by region because it's really different. So the US, it's really all about the millennials who are growing up and growing out as they reach peak household formation years, and the boomers who are growing older and changing their needs. It's different in Europe, where frankly rents are much more regulated, and it shouldn't surprise anyone that when you suppress rents, you suppress supply. So what does that mean in Europe? It means the income streams feel really durable, but you can't grow them. So from our standpoint, what that means is you need to get in at a really attractive yield, a really attractive entry point, and we're finding opportunities to do so. So you mentioned REITs early on. The public real estate companies in Europe are about 2 times more levered than they are here in the US, so that catalyzes opportunities. Then you go to Asia, and look, rented residential as an institutional asset class really only exists in Japan. And we think Japan's really interesting, and we've been investing there. So you're seeing the positive effects of healthy inflation. I mean, we've been investing in Japan for almost 30 years. We've been making money through that period with no growth. So having the growth at our back, that is really exciting. We're seeing rental growth on our residential portfolio 10% plus over the last couple of years. That is something that's been unheard of, and that's really exciting.